If you are starting trading with exactly $100, do not try to grow it. Your only goal is to survive your first 30 trades without hitting zero. You see, growing a small account happens in 3 specific phases. And if you use a phase 3 strategy on a phase 1 balance, you will blow the account. I did it twice. I'll hand you the exact map. Here's the part the gurus skip. A small trading account doesn't grow from clever entries alone. It grows from not blowing up long enough for your edge to compound. Survival first, profits later. So starting out from $100 to about $250, your only job is staying alive. Not making money, staying alive. You're trying to log 30 trades without the account hitting zero. And if you can do that while following your rules every single time, you've accomplished something most small account traders never manage. You're proving one thing: you can execute a plan when real money is on the line. I failed this stage 2 separate times. 2 blown accounts, all under $200, all because I was trading like a phase 3 trader, but on a phase 1 balance. Once you cross $250 and start working toward 500, the goal shifts to repeatability. Same setup, same size, same rules, and same session. 30 more trades. The question you're answering: is this edge real, or did you just get lucky during a trending week? Boring becomes the entire goal. If your last 30 trades look like 30 different traders took them, you don't have an edge yet. When you cross $500, you've earned the right to grow. Small size increases, unlocked only when your last 20 trades show a positive expectancy above a specific threshold. We'll talk about this later. But you don't increase size when you feel confident, not when you had a green morning. The data says yes, or you stay exactly where you are. So here's the decision rule that governs everything. If you can't tell me which phase your account is in right now, you're trading without a map, and your next loss won't teach you anything useful. This is what you'll do from now on. Trade one setup, one market, one session. You see, a small account cannot validate 5 ideas at once. If you trade euro-dollar at 8 o'clock using MACD, try a quick gold scalp at 10 o'clock. Then you trade a moving average crossover on Bitcoin after lunch. You are not doing yourself any favors. That's exactly what the average retail trader does every month, then gets confused why nothing seems to work. The reframe is boring on purpose. Same market, same session, same setup, until your eyes can tell the difference between a clean setup and a bad one. Watch what a phase 1 trade actually looks like on the chart. I'm on pound dollar, 15-minute time frame, London session. I chose this because it's global, liquid, and it gives enough movement for day trading. Price has been trending higher, and there's a pullback into a fresh demand area. The candle taps that zone. A green candle forms, closes cleanly above the level with a full engulfing body, and that tells me the demand is still real. I'm in. Position size is 0.5% of my $140 account, which means my total risk is about 70 cents, $1.50 in profit. Sounds almost embarrassing, but here's what I actually proved. I can identify the setup, wait for the confirmation candle, and follow the plan without bumping size or moving my target. That data point matters more than the dollar. This is the part that directly contradicts everything day trading content has ever told you. Your target on a small account is 1 or 2 trades per day. You don't need 10 trades before lunch. Small accounts don't die from patience. They die from activity, from the belief that more screen time and more clicks equals faster growth. So maximum 1 or 2 high-quality trades per day for 4 weeks. That's your goal. And this rule comes with a kill switch. 2 losses in a row, or 2% account drawdown in a single session. The laptop closes for the day. No coming back. I've watched traders blow up perfectly fine accounts in the 40 minutes after their second loss, chasing the loss back. The kill switch is a circuit breaker designed to protect you from the version of yourself that thinks the next click will fix everything. And I'll give you another protection tool. Open your chart and look at how far price has already moved today compared to how far it normally moves. Pull up an average daily range indicator in TradingView. Once price has traveled 80% of that daily average, you're done. I don't care how clean the setup looks. When 80% of the day's range is used up, your next click may be already late. Price already moved, and you're risking a late entry. So the binary rule: has price moved more than 80% of today's average daily range? If yes, close the platform. If no, you can scan for your one setup. These 3 rules protect you from the market. Watch what happens when you ignore them. This will sound very familiar. So you started the month at $100 and followed every rule for 4 weeks. Account is sitting at 190, but everything is about to collapse. There's a setup forming. Price pulls back into a demand level, and the candle is reacting off the zone. But something is off. The rejection is weak. Price already moved its average daily range. At $120, you looked at setups like this and skip it without hesitation. But at 190, after 4 consecutive wins, there's a feeling sitting in your chest that you figured this out. So you bump position size and you take the B-grade setup. Then your stop gets hit and the account sits at $175. Biggest losing trade this week. Not a disaster. But pay attention to what happens inside your head after this, because this is the moment that separates accounts that survive from accounts that flatline. Your next trade isn't on the plan. It's revenge. You enter because the loss felt unfair, because the chart looks like it owes you one. And this one loses too. $150 left in your account. Then you double size, because the mental math says one winner gets you back to 200. Except your judgment is compromised, and that math is a fantasy you're telling yourself. Account drops to $100. You lost everything you gained in 4 weeks, in 1 hour. I've lived this exact sequence, and every time the trigger was identical. A confidence-driven size increase, then a revenge entry, then a recovery gamble. And the funny part, the market didn't do anything unusual during any of it. It was just being the market, while you stopped being disciplined. There's a name for what killed that first trade. It's called a time failure, and catching it early changes the loss entirely. So go back to a B-grade setup, similar to the one from before. You found your setup, you enter, price moved in the right direction for a few candles, then stalled and reversed. But what if you had a time window on the trade? Here's how this works. You decide in advance how many candles the trade gets to prove itself. On the 15-minute chart, I give my setups 8 candles. That's 2 hours of price action. If price hasn't moved in my favor by candle number 8, my read was wrong, and I close it before the market charges me full price for the mistake. That B-grade trade from before, it would have been a smaller loss instead of a full stop out, which means the revenge chain might never have started. So the rule: has the trade moved at least half of your risk distance in your favor within 8 candles? If yes, the trade stays open and you manage it. If no, and price chops around your entry, you close it and accept the smaller cost. Don't wait for the stop to make the decision for you. Now here's the one that goes against everything you've been told. Moving your stop loss to break even early feels responsible, feels like you're protecting gains. But over 50 or more trades, early break-even moves will systematically cut your winners short, because normal pullbacks stop you out of trades that would have run to target. You move to break-even, price dips 10 pips, takes you out, and then rallies 50 pips without you in it. The backtests on trend-following entries show that traders who hold the original stop capture 30 to 40% more profit than traders who move to break-even. The rule is simple: don't touch your stop until price has covered at least 1 hour in your favor. Below 1 hour of movement, the stop stays exactly where you placed it. If that makes your hands sweat, your position size is too large for your face. Everything up to this point keeps the account alive. What comes next tells you whether you actually have an edge or you've just been lucky. Forget win rate. A 70% win rate means nothing if your average loss is 3 times bigger than your average win. The number that actually matters is expectancy. Take your average winning trade, multiply by your win percentage. Take your average losing trade, multiply by your loss percentage. Subtract the second from the first. One number comes out. Positive means you have a real edge. 0 or negative means you're donating to the market in slow motion. Run that formula every 20 trades. That single number is what decides whether you earn phase 3 sizing, whether you're actually ready to grow. Not your gut, not your P&L from last Tuesday. And here's the move that locks the entire mindset in, the one that 90% of small account traders never make. When your account crosses $120, when you've banked your first 20% gain, withdraw it. Pull the money out in cash. I don't care if it's $20. That withdrawal turns a screen number into physical proof that you can extract money from a market. Without it, the account feels like a video game. You trade recklessly because losing doesn't feel real. But once you've held that $20 bill, every trade after it carries weight. That's the behavioral anchor that stops you from treating the next 50 trades like a game. Everything here keeps the account alive and tells you whether your edge is real. What it doesn't give you is which setup to actually trade. Remember the rules: 1 setup, 1 market, 1 session. Filter to produce 1 or 2 high-quality trades per day. That's the next video. And this is exactly the kind of setup we break down inside our academy. See you inside.